In this video, I will review the only three financial instruments in the world: currency, debt, and assets. In the intricate world of modern economics, there are only three fundamental instruments that form our economic systems: currency, debt, and assets. Every other instrument you hear about, whether it's options, puts, calls, derivatives, bonds, notes, etc., are all derivatives of these three fundamental instruments. The financial industry is not nearly as complicated as the central bankers, stockbrokers, investment bankers, and wealth managers want you to think it is. When you begin to understand this, you will no longer need them, so they hide this truth from you. These interlinked components form the foundation of our global monetary landscape, affecting everything from everyday transactions to international trade. Let's delve into each of these critical elements to gain a deeper understanding of their significance. 1. Currency is the medium of exchange. Currency is the lifeblood of any economy and serves as the medium of exchange for goods, services, and financial transactions. Historically, various forms of currency have been used, from bartering goods to precious metals like gold and silver. However, in the modern era, most economies have adopted fiat currency, which derives its value from the trust and confidence of the people using it, rather than being backed by a physical commodity. Central banks, like the Federal Reserve in the United States or the European Central Bank in the Eurozone, are responsible for issuing and regulating the supply of currency. They employ monetary policy tools, such as adjusting interest rates and open market operations, to influence the economy's growth, inflation, and employment levels. This is usually done more in favor of the central bank's profits than for the people holding and using the currency. Currency stability is crucial to facilitate economic activity and foster confidence in financial systems. 2. Debt is a double-edged sword. Debt plays a dual role in the economic landscape. On one hand, it can be a powerful tool for stimulating growth and development. Governments, businesses, and individuals can borrow money to invest in infrastructure, education, or entrepreneurial ventures, driving economic expansion and job creation. This debt is usually repaid over time with interest, rewarding lenders for their support and risk. However, debt can also become a burden if mismanaged or allowed to accumulate beyond sustainable levels. High levels of public debt can lead to increased interest payments, reducing the funds available for essential services and investments. Excessive consumer debt can lead to financial stress, decreased consumption, and economic slowdowns. Governments, companies, and individuals must strike a delicate balance when using debt as a tool for growth while avoiding over-indebtedness that could destabilize their economies. Unfortunately, the vast majority of individuals' or consumers' debt is used consumer goods, which is just more consumption, which usually creates an unsustainable burden. 3. Assets are the building blocks of wealth. Assets encompass a wide range of tangible and intangible possessions that hold value and can generate future benefits. In personal finance, assets might include real estate, stocks, bonds, and other investments. For businesses, assets can be physical machinery, intellectual property, or brand equity. Governments also hold assets, such as foreign currency reserves or natural resources. The value of assets can fluctuate based on market conditions, demand and supply dynamics, and various macroeconomic factors. Investors and individuals seek to build wealth by acquiring and managing assets that appreciate over time and provide steady income streams. However, asset values can also decline, leading to losses for investors and potential financial instability. The 2008 global financial crisis, for example, was triggered by the collapse of the housing market bubble in the United States, where the value of real estate assets plummeted, resulting in severe consequences for the entire world economy. Currency, debt, and assets form the bedrock of modern economics, which influences the health and stability of individuals, businesses, and nations. Understanding the intricate relationships between these three components is crucial for policymakers, economists, and everyday citizens. Maintaining a stable and balanced relationship between currency, debt, and assets is vital for fostering sustainable economic growth and financial prosperity on local and global scales.